How do you trade gold at the moment? There appears to be heightened risk appetite steering traders and investors back into equities, but gold is holding its own. A bit of a conundrum perhaps maybe in some markets. Well, John Butler is head of wealth services for Gold Money and author of The Golden Revolution. John, welcome.
Thank you.
To what degree is this a conundrum? Because we've got money going into equities, and in fact I think if we bring up a chart to show the S&P 500 against spot gold over 1 year, I've indicated on the far right hand side of both these charts here the lows for equities that we saw, multi-year lows in some equity indices on the 11th of February this year. Money's gone into equities in quite a healthy way. I think we're up 11% for the S&P 500, but money's also been going into gold. Why, and what is going on?
Well, if you look at history, there are times when gold is positively correlated to equity markets, as well as times when it's negatively correlated to equity markets. And so the conundrum, of course, is trying to figure out which of the two should pertain at any point in time. And something that I look at quite closely is money and credit growth, because if money and credit growth is declining, or God forbid it's outright negative, then it's difficult for any asset to rise in value if credit conditions are tightening materially, if monetary conditions are tightening materially. However, if they're easing, then that's different. And in theory, all asset classes can rise if monetary conditions are sufficiently easy. And so this inflection point that we saw recently, when the uptrend that gold was already getting into because of a risk-averse environment with equities coming off, that is negative correlation between gold and equities, suddenly becomes positive correlation. Why? Because all of a sudden people started to speculate that the damage in emerging markets generally, equities and debt, and the damage you were starting to see in the S&P that you just showed us, was getting to the point where it might cause the Fed to stop its hiking cycle right there after just the one hike. And so that sort of thinking really reassessed people's expectations. And money and credit growth, they think, therefore, markets are thinking, might start to take off again. Hence, everything is rising in anticipation.
Because ECB as well, of course,
look at them
releasing the big bazooka.
Absolutely.
What effect does this have on the trader who's got his eyes on gold? I mean, is that a positive or negative? Explain exactly how traders should approach this.
Well, again, the risk aversion side, you could say, oh, people aren't as worried now about equities, so gold won't get as much support from that. But as I mentioned, if people expect money and credit conditions to start to ease again, or to at least not tighten anymore, then in theory, everything can rise in price. That said, if it's not as risk-averse an environment, gold will not rise as quickly, and in relative terms may not be able to keep up with equities, at least for a period of time, until, say, for example, equity valuations become extremely stretched again. Then they'll feel a bit heavy. But as long as money and credit conditions remain easy enough, gold just catches up if you wait long enough. There is no free lunch, right? Equities can't outperform gold in every environment all the time. It doesn't work that way. And all the excessive debt and leverage in the world today is, in theory, quite pro-gold.
Let's go back to the spot gold chart and increase the time period here. We're going back now a couple of years. How do you see this developing? Because we've got this rise that we've seen since the 17th of December. Gold has improved by quite a large percentage margin. I think we're up something like 20-odd%. Since the low points that we saw. We are still only at 1 year highs at the moment. Given what you've just explained about the credit situation and what the Fed's likely to do this year, how do you feel as someone that is interested in the gold market about where we are at the moment and where this is going?
Well, we actually believe that if you look at what's happened statistically, that is in terms of moving averages, that in fact this reversal in the gold price represents a major historical inflection point, of which there have only been about a dozen or so since the Bretton Woods system came crashing down in the early 1970s and the dollar delinked from gold. This move we've seen, this 20 to 23% rise that we've seen in gold now, actually, if you look at it just vis-a-vis an average of historical gold rallies, represents the beginning of something which, on average, becomes at least a 100% rally in the price of gold over a multi-year time frame. That's how big this move is. That's how dramatic this appears in statistical terms. Now, the past is no guarantee to the future, as we know, but simply evaluating what's happened over the past few months with gold and taking a look all the way back to the early 70s suggests this is actually the beginning of a much larger move.
Okay, so doubling from the lows that we saw.
Yes, that's correct.
So stripping out inflation, that would take us above to the record that we saw 3 or 4 years ago.
Over a multi-year period. Yeah. Again, these rallies don't occur overnight. Okay, they do take some time to play out.
What could stall that?
Well, certainly if the Fed gets religion If the Fed really believes that in fact inflation is the problem, growth is at least okay, they're willing to tighten the screws a lot on asset markets generally, gold will struggle to rise, obviously. In fact, it will probably get right back into a downtrend. But for those of us, this includes me, who believe that the dollar is already so strong as a currency, it's already causing problems in emerging markets, it's already causing problems in other risky asset markets. If the Fed keep raising rates, the dollar will remain strong to the point where it threatens to bring down, and cause multiple balance of payments crises. I don't believe the Fed want that to happen. I think they think far more internationally than they used to, and for better or worse, depends on how you think about these things longer term, I think they're going to blink sooner rather than later, and that will unlock a lot more potential in gold.
Okay. I know that you don't have an official gold target as such, but how do you feel about targets? What do you feel about gold? Where is it going, in the next year or so?
Look, it's helpful to have a target, and there should always be some time horizon on that target. And when I think medium term, and I look back at what's happened through the bear market of gold that we went through since 2011, the size of this retracement, the speed of this retracement, what I think the Fed will do, I think 1,500 by year-end 2016 is a reasonable upside target for gold. I do believe we're higher at year-end than lower, and again, the order of magnitude for what I think is a fair rally to expect is about $1,500 per ounce.
Okay, that takes us then back to 11th of April 2013. Just give us some sort of context as to where things are moving. But look, it's fascinating, and I know that we've got to have you back in to talk a little bit more about this later on in the year when you get more clarity, certainly from the Federal Reserve and what the ECB is doing as well. But in the meantime, John, thank you very much indeed for joining us. That was John Butler, author of The Golden Revolution.